Hi everyone, my name is Connie. I'm the Director of NZ International Tax and Property Advisors. Welcome to another video. In this video, we'll cover some tax issues when New Zealand tax resident holds foreign shares. Before we start, I'd like to tell you a little bit about myself. So I'm a chartered accountant, property consultant, and an ex-tax lecturer. I have more than 10 years of tax, accounting, and property experience working in Big Four, mid-tier, small boutique chartered accountant firm and with residential and commercial property investors with portfolio size ranging from 1 million to 10 million. We're a one-stop chartered accountant firm for tax, accounting, property consulting, and training services for migrants, property developers, property investors, and SMEs. We specialize in taxation land transaction, property consulting for landlords and tenants, cross-border taxation for migrants, SME tax, and IRD disputes and resolutions. Here's an illustration of the case study we'll discuss today. So a New Zealand tax resident holding some foreign shares with shareholding of less than 10% or between 10% to 50%, which is not a controlled foreign company. Firstly, we need to determine whether the offshore investment fall under the Foreign Investment Fund rules or the Controlled Foreign Company rules. So this depends on the shareholding interest in the offshore investment. Where the New Zealand resident holds interest of less than 10%, whether or not is a controlled foreign company or not, then the Foreign Investment Fund rules could apply. And where the New Zealand resident holds interest of between 10% to 50% and it's not a controlled foreign company, then the Foreign Investment Fund rules could apply. And lastly, where the New Zealand resident with the interest of 10% or more in a controlled foreign company, then the controlled foreign company rules could apply. In the case study, given the shareholding interest is less than 10%, or between 10% or between 10% to 50%, which is not in a controlled foreign company. So the Foreign Investment Fund should apply. So there is a three-step plan to apply in a Foreign Investment Fund scenario. For the purposes of this video, I'm just going to say FIF as a short name of the Foreign Investment Fund. So firstly, you want to identify whether you have a FIF. If you do, then does any of the exemption apply? If none of the exemption apply, then we need to choose the appropriate method for the taxpayer. So step one, do I have a FIF? So FIF applies to NZ tax resident who holds interest in an attributable FIF, which is not exempt. The main category of FIF interest comprises of shares in a foreign company, although similarly classified as an interest in a foreign superannuation scheme and foreign life insurance policy are also FIF. But for the FIF superannuation interest, from the 1st of April 2014, in general, an interest in the foreign superannuation scheme is no longer an attributing interest subject to the FIF rules. So taxation applies to distributions when received. However, an interest in a foreign superannuation scheme is still subject to FIF rules, where either the person had applied the FIF rules to the interest in a return filed before 20th of May 2013 and continued to apply those rules, or the interest was acquired when the person was resident in New Zealand. And also pointer there is that the transitional resident do not need to comply with the FIF rules. So they've got 4 years to do some tax planning if needed. Step two, do any of the exemption applies? There is a long list of exemption, but I've only highlighted the common ones here. So firstly, for natural person, there is a de minimis threshold of 50,000 NZD. So which means that if you have foreign shares that costs less than 50,000, you may be eligible for this exemption. Secondly, certain Australian resident listed companies are also exempted from the fifth rules. The exemption is restricted to companies listed on the approved index of the Australian Stock Exchange. So there are certain criteria to meet before the exemption applies. So we need to review the taxpayer circumstances to advise whether this exemption would apply. And thirdly, the employee share scheme for grey list company. So this exemption only applies to foreign company, which is a resident in the grey list country, for instance, Australia, UK, US, Germany, Spain. So, and there are a few more other countries, but these are the main key ones. It is also the employer of the employee, or owns directly or indirectly the New Zealand resident employer of the employee. So similarly, there are other criteria before the exemption applies. So we need to review the taxpayer circumstances to advise whether this exemption would apply. And step 3 is to choose the method for calculation that is appropriate in your circumstances. So the first method here is the fair dividend rate method. It's calculated based on the 5% times the opening market value plus quick sell adjustment. And secondly, the cost method, where there is no market value, we can rely on the cost. So the formula is 5% times the opening cost value plus the quick sell adjustment. Thirdly, comparative value method. Essentially, it's the closing market value plus the gains, less the opening market value plus the costs. Essentially, it's taking the movement between the years of the shares. Fourth method is the deemed rate of return method. Can only be used for non-ordinary shares if the comparative value method is not practical. And lastly, the attributable fifth income method, which is in the formula is the net attributable income times the income interest. So net attributable fifth income times the income interest. So essentially, the fifth rules tax income on accrual basis rather than cash basis. If the fifth rules apply, then you need to return the income in relation to the foreign stock calculated based on the appropriate fifth method. If fifth do not apply, then the return of income is on cash basis, which is when the dividend is received in the relevant period. So how can we assist here is that we provide a 30-minute free consultation for new clients, so we can advise them how we can assist with our service offerings. We also offer annual subscription for 10 question and answer for tax, accounting and property matters. Subscribers have access to 15-minute Q&A with us for a year, and the charge is $400 plus GST and 3% disbursement. If you would like to know more about our service offering, you can go on our website, and it's nztaxprop.co.nz. So yeah, lastly, if you've got any tax, accounting and property questions, feel free to email us at info@nztaxprop.co.nz or call us at 022-061-6521. If you're calling offshore, you need to add an 0064. So it's 006422061651, and that's our number for offshore callers. If you're interested in further tax, accounting or property updates, make sure you have subscribed to our website at nztaxprop.co.nz or our YouTube channel, so you're not missing anything out. And please hit the thumbs up button if you found the video helpful. And thank you very much for watching, and I'll see you in the next video.